Hey guys, Angelo Christian here with another great edition of Real Estate Insider. Today we're going to be talking about how mortgage rates work, and we're going to explain and go through the whole process. When you're buying a house, it's a very confusing process, and one of the biggest things is what's the mortgage rate and how exactly does it work? How does the market affect it? Does my credit affect it? Do I have to pay a higher interest if I have a lower credit score and all of this? So I'm actually going to be breaking down today how mortgage rates work so you can understand how to get to obviously the lowest rate that you want, because obviously a lower rate means a lower payment for you. We always want to pay the least amount and get the most with our money, right? So we have to look at there's different types of mortgage rates, and with different types of programs, different types of credit, and the market has a huge influence on that. We'll actually be talking about that today. I'm going to show you exactly what affects mortgage interest rates, and a lot of people don't know. It's kind of a confusing system of how it works, how they determine what interest rates are. You've seen back in the 80s when interest rates for a house were 18%. Just last year, you could get a 30-year fixed mortgage in the 3% range, and now they're in the 4 to 5% range. You're probably wondering, well, what's all this shift in the rates? I have to pay more money now. My friend got a mortgage 6 months ago with a 3.5%. Now I'm paying 4.5%. Why is that? So we're going to talk about that. The first thing is to know that basically, with a bank type loan, a conventional loan, it's very credit score centric, meaning that it's very focused on what your credit score is. So obviously, if you have a higher credit score and you're getting a loan from a bank, you're perceived as less risk. And banks use the FICO score model, and normally there's Experian, TransUnion, and Equifax. And when the underwriter will take the middle credit score of the three scores, doesn't matter what depository that it comes from, but they're going to take the middle score of the three, and that's how they're going to determine how to underwrite your loan. So if you have a 650, a 680, and a 700, they're going to take the middle score, which is a 680, to underwrite the loan. Okay, and that's what they're going to determine what your interest rate is with a government loan. With a government loan like FHA, VA, and USDA, it's not as credit score sensitive. It's more leniency on the credit. So pretty much everybody that has 620 or 640 or higher credit score is going to get basically the same type of terms on their loan. So that's why I always tell people, if you already have a 700 credit score and you're getting an FHA loan, you get into a 740, it's not going to make a difference on your interest rate. So what plays more of a role is the size of a loan that you get. Usually you want to try and get a loan at least $150,000 or higher to get the lowest rate, because smaller loans, they have higher interest rates because the banks like to lend more money. But then the biggest other thing that determines what the interest rate is, what's happening in the global economy. What is the Federal Reserve? You heard of the Federal Reserve? They play a role in not so much what the market's going to do, but how the mortgage rates are affected. And that's by something called the 10-year Treasury yield. So the 10-year Treasury yield, which is the government does, they auction off and they sell treasuries out to investors, mutual funds, countries, and on the yield curve, there's daily interest rates for products, 2 years, 5 years, 10 years, 20 and 30-year bonds that are issued, and they pay a certain interest rate per those particular bonds. And the 10-year is very closely tied to what the mortgage rates are doing. So you see that if you watch the 10-year, we're actually going to pull it up here on the graph so I can explain to you so you can actually see kind of a visual. I'm just going to pull it up on the screen, and this is recording already. So, okay. So, and this is actually an interesting day in the market. So you can see up here that the Dow Jones and the S&P, they all had they rose over almost 1% today. So hot rise today in the market. And you also see that the Treasury yields went up. So typically what this means is that when the market's going higher, and it's not 100% correlation, but generally when the market has a huge rally like this, the Treasury yields go up because that means interest rates are going higher. When you have a healthy economy, like we've seen the stock market take off, apparently we're in a healthier economy, interest rates go higher. So this is the amount of yield or interest that's paid on a 10-year loan, which is 2.789%. So that means that if you buy a 10-year bond from the United States Treasury, they're going to pay you 2.789% every single year to hold on to that bond, right? Now, if the stock market, took a huge dive today or crashed, this would go down, meaning that the yield would go down. So let's say that the market crashed, 100 points in the in the S&P, which would be pretty big. Then your yield would go from 2.78 maybe down to 2.5. So that means that investors are scared and they're selling the equities and they're buying the bonds. So what ends up happening is that the interest rate on the mortgage has the inverse relationship to what's actually happened to the bond price, but not the yield price. So basically the yield today, if it's at 2.79, you see it's in green, it's going up. That means interest rates are going up. If this yield is going down, that means that mortgage interest rates are going down. And you can see that. I'm just going to show you this is on a one-day chart, so it's not really. Let's look at a longer term chart. Let's look at a year. So look at a year. So let me see if I can also. I think we can expand this. Well, you can see it right here. So let's look back in a year. Look at what happened in September of 2017. The yield dropped down to 2.03%. That's probably when you saw mortgage rates below 4%, because lower 10-year yield is generally a lower mortgage rate, right? So you can always come here. This is just Market Watch. You can do this on Yahoo Finance, Google Finance. You can even go to the government's website, look at the Treasury yields. I'm on just to let you know, guys, I'm on marketwatch.com, and you can track all this. Any of them are good. But if you look at this graph, this chart, it's showing you what the yields were. So look at what happened in July of 2016. The yield went all the way down to 1.3%. That means that mortgage rates got really low around that time frame. So that's awesome if you're trying to buy a house. The thing that I want to point out to you, and I think that you can see too, is that the trend is that rates are on the rise, right? I mean, look at the trend. Rates are on the rise. So you're looking at now a Treasury yield almost 3%. That means mortgage rates are going to go higher. So that's why I'm telling you that if you're trying to put off buying a house, it doesn't make any sense, because the further you put it off, the further the dream of owning a home is going to get away from you. Because if those Treasury yields, when they go higher, it's not a matter of if, it's just when. The Federal Reserve says they're raising rates. So if that Treasury yield goes to 5%, you're going to have a 7%, 8% 30-year mortgage loan. And then you're not going to be able to afford the house because the payment's going to be too high. So that's why I'm telling you, now's a great time to buy a home and lock in. And so that way you can get a better deal. Because look at this back in 2008. Treasury yield was 5% and 6%. Back at that time, I was doing mortgages with 10% interest rates, 12% interest rates. Wasn't a big deal. 8% 30-year fixed, no problem. So you see, so the thing is that they're a lot lower now. So now is a wonderful opportunity and a wonderful time to be able to own a home. So if you're ever wondering what the trend is, or how to determine how do mortgage rates work, you can come here and look, and see how mortgage rates work, to look at the 10-year yield. And know that an interest rate, just because you're quoted a certain rate, doesn't mean you're going to get that rate. That's the market rate. See, these rates change, these yields change all the time. This thing, today, moved around. Look how much it moved around today. So if you got a quote from your lender today in the morning, it's already changed by the middle of the afternoon. So that's why your loan's only going to be locked in once you're cleared to close and everything's been satisfied. So you see, it's not your lender that makes that decision. It has to do with the overall market and the economy, right? So, you know, there is small subtle differences between different mortgage companies and banks, but it's very little. Most of it's going to come from the market and depending on what's happening in the market. Because if the whole market's moving up, your interest rate on your mortgage is going to go up, your car loan interest rates, your credit card interest rates, everything's going to go higher. So, but this is a great way to learn about how these mortgage rates work so you can have a better understanding and know how to use this when you're trying to lock in and when you're trying to buy a house or try and buy a car. My suggestion is if you're trying to do that, it's better to do it sooner than later, especially with how this trend is going up. So anyway, you guys, if you don't know who I am, I'm Angelo Christian. I'm a certified mortgage expert nationwide, #1 lender in the United States. I've been doing this for 15 years. I helped over 12,000 families get into a home. We offer all the programs, FHA, VA, USDA. You can reach me at 832-431-6331. You can also, if you're looking to buy a house, reach out to me. You're looking to refinance, you're trying to grow your career with our Mortgage University. We also have our Mortgage University. We train top producers on how to grow and expand their career. Reach out to us. You can click on the chat box below to get more information or sign up below to get pre-approved or to sign up for Mortgage University. We'd love to hear from you. We're growing and looking for great people also to bring onto the team and also to invest with us, whatever your situation is. And you can please follow us on Instagram, Facebook, and YouTube. Just follow us below. Share this information if you know someone's trying to learn and get better. We produce 3 great shows every single week. We work very hard. All this is free content. We don't charge for it. And our purpose, our mission, is to empower you guys out there to learn, expand and grow, help you to become a homeowner, help you to get a better career. That's what we do with Mortgage University. So anyway, thank you guys so much for checking us out. We'll see you guys again next week. Take care.